Chapter 8 is all about receivables. Most of it is on accounts receivable. There's a portion of it that's on notes receivable. Okay, and then of course some analysis. We're going to split it into two parts. We're going to do the first half of the chapter today. Again, first objective, pretty straightforward. Much of the work is going to be part of the second objective today. So let's get to the straightforward piece, and that is remember how an accounts receivable is done, how it's created, right? These are usually business to business transactions when one business sells something to another business on account. Remember that little phrase on account comes up over and over and over again. It's important. And normally speaking, the accounts receivable is something that is owed within a 30-day period. Sometimes, as you remember from chapter 5, there's a little sweetener in the term. Sometimes they'll say, look, 2% if you pay within 10 days. If not, the net amount is due in 30 days, 210 net 30. And sometimes that's taken advantage of, sometimes it's not. So again, still on business to business type of things. This is where accounts receivable is basically created. Sometimes, again, 30 days is not enough. Some companies might need longer to pay. Some might need 60 days, 90 days, 120 days. So some businesses say that's fine. What we'll do is we'll change your accounts receivable to a note. In other words, we'll make it a loan. And then a couple of things come with this loan, right? There's a due date and an interest rate. And so they're going to be charging interest on the money that's outstanding until the due date. With the notes receivable, everything gets received, both the original loan plus the interest, all on the same day, all on the maturity date. If you look at a company's books, they have lots of other receivables. We're not going to be getting into those in our class, but your book does mention there's quite a lot of other receivables that could be on the books. Okay. So in terms of receivables, they can make up a substantial percentage of total assets for some companies. So here what you see is, and I'll stick with the first one here, you have Ford Motor Company. Look at that, a whopping 43% of their total assets are in receivables. Okay. There's a reason for that. It's just the way this particular business industry is structured. As you know, Ford Motor Company makes, cars, trucks, SUVs, things like that. As a manufacturer, they will sell those in large quantities to a wholesaler or a distributor. Okay, and the wholesaler and the distributor will then sell those to the individual dealerships that you and I might have seen a lot of. So basically, all this is happening, and manufacturer of automobiles, they sell it to the distributor, wholesaler. When they sell it to the wholesaler is not paying cash for much of this. They're putting some down, but most of it is they're waiting. Ford Motor is waiting to receive money from the wholesaler. The wholesaler, when they sell to the dealerships, okay, when they sell to the dealerships, are also selling to them on credit. So there's an outstanding accounts receivable that the wholesaler is expecting as well from the dealer. And so when you and I go to buy a car, this is supposed to be you and I, kind of like a little ant formation there. Right, we pay the dealer then pays the distributor, wholesaler, who then pays the manufacturer. So it's a very long line of receivables in this particular industry that's waiting to get paid, which kind of explains the reason why such a large percentage of the assets. But for most businesses, it's not a large percentage of total assets. It is something that they do with other businesses, but doesn't consume that much. You might also remember that service organizations also have accounts receivable, right? That's when they perform a service on account, right? They do work for someone and they give that business a bill, right? So that's on account. Right? When you're selling something on account, you're going to have an accounts receivable. We all know what happens from chapter 5 with merchandisers when they sell or they buy merchandise on account, right? There's a lot going on there. Remember that business to business transaction we had in chapter 5 going on between Sock Stereo and PW Audio. Accounts that were there, that represents an accounts receivable. Now, does the account receivable, does all of it get collected? No, because, two things happen. First, there's those returns and allowances that happen. So as returns and allowances happen, those receivables go down. And then, of course, if the receivable has a nice little incentive, hey, 210 net 30, pay early, take a discount, that discount is going to also affect the accounts receivable. So in other words, just because a company says they have $100,000 of accounts receivable doesn't mean it's worth $100,000, right? Because it could shrink with returns and allowances. It could shrink even further with discounts. So again, accounts receivable is an asset account, but it's got to be valued properly. That's going to be a big focus of learning objective 2. So keep that in mind. Okay. Of course, you all know how this works. You've seen this way back in chapter 5, so this shouldn't be a big deal. Here we have Jordache Company, July 1st. They sell merchandise on account to Polo, $1,000 worth of merchandise, 210 at 30. Right. So on the books of Jordache, they're going to record the sale, but they're going to be debiting accounts receivable because it's on account. Right. When you sell on account, that sets up the accounts receivable. Right. Probably remember that. Again, it looks like Jordache has $1,000 of receivables. Well, guess what? They get some returned merchandise, $100 worth of returned merchandise on the 5th of July. So what do they have to do? Well, they're going to debit sales returns and allowances. You might remember that. They're going to credit receivable, right? They're going to lower their receivable. So now the receivable is $900, the $1,000 it started with, minus the $100 return. Now receivables are $900, not $1,000. And they did offer Jordache 210 net 30. So if they paid within 10 days of the invoice, take 2% discount. So that's what Jordache did. They sent them $882 to settle $900 of receivables because that 2% meant taking a discount of $18. So again, this is going to be a big thing for our learning objective 2. Accounts receivable is an asset. Once you say you have a certain amount of receivables on the balance sheet, you're basically telling investors and owners, this is how much we have in receivables. This is the value of the receivables. When in actuality, it's never going to be that valuable. There's always going to be returns and there's always going to be discounts applied. And then one thing that you all know happens. Sometimes just because you're expecting to get paid, you're expecting to receive something doesn't mean it's going to happen. And look what happened during the last year. We had a lot of businesses who went out of business. So they couldn't pay some of the money they owed to other businesses. In other words, those receivables went bad. So we're going to be looking at that. Accounts receivable is a very important asset account, but it's not always worth what we're expecting. So do a review for learning objective 1 is pretty straightforward because you've seen it before, sort of a review from chapter 5, right? So here we have May 1st, Wilton sold merchandise on account to Bates, $50,000. Terms are nice. $315 net 45. So they get a 3% discount if they pay within 15 days. If not, the whole amount's due in 45 days. Okay. So that's what happens on May 1st. So on May 1st, they're going to set up a receivable because they're expecting $50,000 to be received from Bates. But what happens? Well, on May 4th, Bates returns merchandise for $2,000. Okay, well, we have to adjust our receivables, right? So we're going to debit sales returns and allowances for the $2,000 that were returned to us, and we're going to lower our receivables by $2,000. So now our receivables are $48,000. And then on May 16th, they receive payment. Well, that's within 15 days because May 1st, right? The first full day would be May 2nd. So you're going to start from May 2nd. So May 16th is the 15th day after the sale. If they pay, they get 3% off. So although it looks like they're owed $48,000 of receivables, they're only going to be collecting $46,560 of cash. Why? Because that 3% discount was $1,440. So yes, they did get their receivable paid, but it wasn't worth $48,000. It was only worth $46,560. Right. So that's very, very important to recognize because it's going to help you understand why we need to look at learning objective 2. Because accounting, remember, we have to value things conservatively on our balance sheet. You saw that happened in the last objective, the last module, where you saw inventory had to go through that lower of cost or market sort of standard to make sure we're being conservative in valuing our inventory, right? Inventory is an asset. It's on our balance sheet. We cannot overstate those values. Okay. So guess what? Accounts receivable is an asset. It's on our balance sheet. We cannot overstate the value of our receivables. So we have to make sure that we're valuing the accounts receivable properly. And as you know, it looks like a little bit of a moving target, right? Because of returns and allowances, because of discounts. Is $48,000 of receivables really worth $48,000? No, we know that. And then in addition to that, we have to know that some receivables are not going to be able to get collected. We are going to be doing business with many, many different businesses and extending them the benefit of doing business on account, making sales on account. Well, what if they're some of the ones that are affected by the pandemic or other types of issues that they might be having? And they can't pay them. That means we're not receiving. Well, so on occasion, accounts receivables go bad. In other words, they're not collected. They're unable to get collected. We're waiting to receive it because we've already done the work. We're waiting to receive that cash because we've already delivered the goods, but it's not coming. Well, we need to recognize that sometimes we lose money when we extend credit to other people. And that's results in something called a bad debt expense. A bad debt expense is an expense account. It's a brand new expense account that you're learning about today. Amen, hallelujah. Is it a life grant? Okay. If you are a small business, meaning a sole proprietorship, a partnership, or a corporation that's not public, you can use your bad debt expense as often as you want. However, if you are a public corporation, which is what we're studying here, bad debt expense is only something you can take once a year. Okay. And you're going to find out exactly why. The reason is that GAAP, and I'm going to start from the bottom up here. Okay. The reason is that GAAP says what we really need to do is we have to use something called an allowance method. That allows us to estimate our bad debt expense on a year-to-year basis before we close our books. Remember, we're closing our records, we're closing our accounting records. At the most we can have is 1 year. Bad debt expense is something public corporations only calculate once a year. Okay. Because GAAP requires them to estimate, okay, and make an allowance for it. But like I said, if you are a small company, whether you're a sole proprietor or partnership or a if you're a private corporation, you're not public, you can use something called direct write-off. They forgot an F here. What the F was going on there? They could use something called a direct write-off method, which is what I said. Just as soon as they identify someone, they can just use a bad debt expense to clear it out. The problem is that we're doing financial reporting. And if you just can randomly write off an account, it's not desirable because you're not matching up your revenues and expenses. Okay, so you can't use a direct write-off method if you're a public corporation. If you're public, you have to use GAAP. GAAP, remember, is generally accepted accounting principles. Okay, generally accepted accounting principles. We learned about that in chapter 2.
Thank you. I was absent because I was driving across country.
Oh, okay, got it. No problem at all. So this is what we have to do. You already know accounts receivable is an asset account. What you don't know is there's another asset account that follows it. And this is the second new account you're going to be introduced to today. The allowance for doubtful accounts is a real account. It's an asset account. It goes right underneath the accounts receivable account on a balance sheet. Just like accumulated depreciation for equipment goes right underneath equipment on the balance sheet. That's the type of relationship these two accounts have. So here you have accounts receivable, and this is just an example, shows a $500 balance. Notice accounts receivable and asset account, right? The balances would be on the debit side because asset accounts have balances on the debit side. But the allowance for doubtful accounts is a contra asset. It's going to have its balance normally on the credit side of the account. So what this is telling us, just by looking at these accounts in the ledger, is this particular company has $500 of accounts receivable, but has estimated 25 of that will be set aside for bad debt, will be its allowance for bad debt. A doubtful account is a bad debt, basically. You can be doubtful about that, but it is. So this is how it looks in some balance sheets. Again, the accounts receivable account is listed. It is a current asset, so you'll see it here. And then you will see also the allowance for doubtful accounts listed right underneath it. Again, it's subtracted to get the difference. The reason we do this is because 475 is a much more conservative estimate of what the value of the receivables really are. Take into consideration what we just said, right? There are discounts, there are returns and allowances, and there are bad debts. There are simply just other businesses that aren't going to pay. We're waiting to receive money from them, but they're not going to pay us for whatever reason. Right. So that 475 that you see there is a conservative estimate of what the real value of accounts receivable is. We actually call it the net realizable value. You'll see that if you read the book, you will see net realizable value listed. That's basically our conservative estimate of what the value of accounts receivable is after taking into account an allowance, right? Knowing what we know. Although this is in your book as an alternative presentation, this is practically the only presentation you will see if you ever look up balance sheets for any Fortune 500 company. They will show this on the balance sheet accounts receivable net of allowance. Okay, so basically the 475 they list here is the net amount, in other words, already taken into consideration this $25 allowance. This is very commonly what you'll see on a balance sheet of a Fortune 500 or any corporation. If you just look, that's what you're going to see. Accounts receivable net of allowance. Okay. So for those businesses, these very small businesses, they can directly write off a debt. Again, public corporations cannot, but just to show you the difference, this is how it works. So for smaller companies that use, we call direct write-off, as soon as they identify an account, so in this case, Warden Company has identified Doran's $200 balance as uncollectible on the 12th of December. So they simply just write it off as a bad debt that day. Okay. So on the 12th of December, they will debit bad debt expense and credit accounts receivable. Okay. So that's basically what a smaller business can do. Without a doubt, it's perfectly fine. However, it's not acceptable for a public corporation. Okay. Again, we have that revenue recognition principle. The expense recognition principle requires us to match it in the same period of time. The accounts receivable would look bigger under the direct write-off method because they're not adjusting it. They're not making any allowance for it. They're just listing it all. And if something is bad, they'll write it off. So the receivable is going to look more valuable than it really is. Okay, which is why it's not acceptable for GAAP. Okay. In GAAP, we have to use something called an allowance method. And basically, this is how it works. The first step is companies estimate what they believe their uncollectible accounts will be. The estimate has to come at the end of the year. This only happens at the end of the accounting year. Okay. So at the end of the accounting year, they will first estimate what their bad debt would be, what their uncollectible account would be. And then at the end of the year, they would debit their bad debt expense once. It's like an adjusting entry. It just does once at the end of the year. And they'll credit the allowance for doubtful accounts. Remember, the allowance for doubtful accounts is a real account. It's an asset account, but it's a contra asset account, which means it has an opposite balance. Okay. I don't know. I don't know. I just got a question and I'm not sure how to answer. The third thing that they would do is, so this is something they do at the end of every year. And then as the year that is going on and they are able to identify businesses that are not going to be paying them, then they take the money out of the allowance account and close the accounts receivable for the business that is not paying. So you're going to see how that works right now. So the first things first, at the end of the year, they have to estimate their uncollectibles. So this is a furniture company that in 2017 had $1.2 million of what we call credit sales. This is a very interesting term. Credit sales is the same as selling on account. Remember a sale on account? Credit sales and sales on account mean the same thing. They sold it on account, credit sales. So during 2017, they sold $1.2 million worth of furniture on account, okay, throughout the whole year. At the end of the year, $200,000 of that is still there. So this $200,000 is their accounts receivable. That is their accounts receivable. They've collected the rest. But at the end of the year, that's their accounts receivable. Their credit manager has estimated $12,000 of that will be uncollected. So again, the estimation has to come at the end of the year. In this case, December 31st is the only time they can do this. So based on what the credit manager has estimated, they will debit their bad debt expense for the $12,000. And they will credit the allowance for doubtful accounts. They'll put this bad debt into the allowance so they can take the expense for the year and close out the record, but keep that money aside so as they identify the specific accounts that they can't collect, they will know how to close it. They'll close it from this account. And that's how it's different from the direct write-off method, which they can use bad debt all the time. Not a great way to do it. So their balance sheet's going to look a little bit like this. Their accounts receivable is going to show the full $200,000 of receivables that they're owed, but they're also going to tell their owners that they've made an allowance for $12,000. They think $12,000 of that is going to be bad debt. So the net realizable value, right, the conservative value of their receivables has been reduced to $188,000. That's a more realistic value of how much cash is really going to be collected here. That's the real value, NAV. I mean the net realizable value. So what happens after they do this? Well, the year starts. We're already in March. And the vice president of finance of the company says, hey, we have a $500 balance from this client, R.A. Ware, that we're going to write off. You know, this guy's nowhere to be found. Get it? Nowhere to be found. Plus, they are aware that they're not going to collect any money. How's that? Pretty good, huh? Okay. So now that they've identified this client, R.A. Ware, that they're not going to be getting this $500 from him, now they can write him off. They take the money out of the allowance account. That's why the allowance is there. You take money out of there, and then you can close the receivable for Ware. Now that $500 accounts receivable for R.A. Ware is gone, zeroed out, because they were able to close it by taking the money out of the allowance and putting it into R.A. Ware's account. Now, when that gets posted to the ledger, you'll see that the allowance for doubtful accounts and the accounts receivable account have been affected by that $500. But notice the balance of $199,500 minus the allowance for $11,500 doesn't change the fact that the total was $188,000. That's still the total. That number changed, that number changed, but this number didn't. Right. So please know, again, the accounts receivable balance might have changed, the allowance for doubtful accounts might have changed, but the net realizable value of receivables stayed the same. That's the benefit of the allowance method. Right. Under the write-off method, every time they do a bad debt expense, everything changes, including their balance sheet. So it's messy. It's messy, for sure. Looks even a little unstable. Well, sure enough, a few months go by. We're in July already. And guess who shows up? R.A. Ware shows up. Got 5 Chris Benjamins in his hand. Says, hey, man, how you been? Sorry, I've been out and about, but I really do want to pay that $500 I owe you. Well, you know, if someone's standing there with 5 Chris Benjamins staring at you, you just don't say no to that type of stuff, particularly when they owe you the money anyway. They don't tell him that he was written off. They'd be stupid to do that. They don't tell him that. So what do? Well, they're happy to take his money, but before they can, they have to reestablish his account. So they'll put R.A. Ware's account back in the receivable. So they'll reestablish his $500 account in accounts receivable and put that money they used back into the allowance account for the next schmuck they identify who didn't pay him. And then they'll grab those 5 Chris Benjamins and debit their cash and credit accounts receivable. Because this is what we want to happen to accounts receivable. We want our accounts receivable to turn into cash, right? That's the whole goal. So this is perfect. Now, does this actually happen in real life? Yeah, actually it does. Why? Well, let me tell you. Remember, this is a business to business. Accounts receivables are business to business. You and I can't go in the store, take a bunch of things, say, hey, and give me an invoice. They're going to call the cops. We're going to have a court date, not an invoice, right? So this is a business to business transaction. They have made that decision to sell to that business on account. Now, if something bad happened in that business, they couldn't pay. Yeah, it's messy. But would RAWare show backup? Yes, because RAWare probably needs them. He might be a small plumber who goes to that store for his plumbing supplies, right? And so reestablishing that relationship is in his best interest because he still wants to be a plumber, right? He still wants to do his business and he needs them. So reestablishing that relationship is very important. So yes, it does happen. That doesn't mean that automatically that he can start taking stuff out on account. No. What the business will do is say, okay, we'll be happy to do business with you, but we need you to pay cash up front. We're going to do cash sales with you for the next 6 months or a year, whatever. And then after that, if you're doing good, we'll go back to our arrangement of selling things to you on account. And that would be a reasonable thing to happen in real life. So we talked a little bit about the fact that businesses have to estimate what their allowance for doubtful accounts is going to be. Under GAAP, there's 2 choices. They can actually use something called a percentage of receivables. Actually, it's a simple one. They just, based on the history, because these are public corporations, they've been around for a while. Based on the history, they can look back and say, look, we write off 3% of our receivables go bad. So let's use 3% of receivables as our basis for estimating what the bad debt's going to be. Boom, there you got it. They have a track record of about 3% a year for the last 5 years or so. Using 3% is quite reasonable, and the accountants would give a nod of yes, that's a good idea. Okay. So that percentage of receivable gives them what their uncollectible is going to be. Now, again, under GAAP, you can only take that bad debt expense once a year. And the rest is going to be sitting in the allowance for doubtful accounts. When they do the estimate of the percentage of receivables, they're saying, look, this is what our doubtful accounts should be. Okay. They do that every year. Well, maybe there's still some leftover balance in the allowance account. So they can only really write off the difference between what they want it to be, which is the required balance, and what's actually already in there. They can only write off the difference, and that's what you're going to see happening. The other way to estimate receivables is called an aging. Now, an aging is also what I do in front of you every week, for the last 10 weeks, 12 weeks. But in addition to that, we can use it in accounts receivable. How nice. Accounts receivable aging simply means how old is the account. Right. So it starts off with some basic stuff. This is information of all your specific customers. And if this list would go on, then you wouldn't just say others here. It'd be all of them would be listed. These lists can be quite big for a lot of companies. The next column shows how much the receivable is for each customer. For this company, they have a total of $39,600 of accounts receivable. Pretty good. Now remember, accounts receivable, selling something on account. You usually give the customer about 30 days to pay. So there's a whole bunch of that that's not due yet. In other words, the 30 days to pay hasn't come due. So as you see, that affects most of them. So 27,000 of the 39,600, the due date hasn't happened yet. Amen, hallelujah. But guess what? They are going to estimate that 2% of those will end up being bad debt. So they've estimated $540 of the $27,000 that hasn't even been due yet. It's going to be bad. Then we get into these lovely columns here where we actually are past the due date. In the first column, they've missed the due date by either 1 day or up to 30 days. So it was either due yesterday and it's not here with you today, or it's 1 day late, or up to 30 days late. Okay. As you see, the total amount that's 30 days, up to 30 days late, is $5,700 of the original $39,600 balance. Now they feel because it's a little bit late, they've upped the amount of that they expect to be delinquent. 4% of that is going to be not collectible in their estimates. 228 is 4% of 5,700. The next column, now you've been waiting 1 to 2 months. Hello, I've been waiting by the phone. 3,000 of the 39,600 is late, 1 to 2 months. Now, the longer you wait for your money in general, the less likely you're going to get it. So now they've increased the likelihood to 10% of that will not be collected. So they've put 300 aside of that as bad debt. The next column here, as you see, 2 to 3 months late. A lot. But that thankfully only represents $2,000 of the $39,000. Hey, look, that's just doubled. 20% of that, they think they're never going to see. And then these are the ones that are over 90 days late. Holy moly. You know, what are you waiting for? Again, thankfully, it's not a ton of money. $1,900 of the $39,000 is that late. But boy, we think we're gonna be kissing much of that goodbye. When they add all these together, all these estimates, you get the total, 2,280. This is what they want their allowance account to be. In other words, when you look at the allowance account on in the ledger, the allowance for doubtful accounts, they want the balance to be $2,228 to match what they've estimated. That's basically what they want. Again, this is the debit side, that's the credit side. So again, 2,228 is what they've decided the allowance account balance should be based on their estimate. So the question is there any balance in here already? Right. So if there's like $228 or still left in there from last year, they can't write that off twice. They can only write off the difference. That's what that meant. Okay, can only write off the difference as your bad debt expense. So let's take a look. Oh, look at this, an illustration. It looks so familiar. It's also the a trial balance with the allowance for doubtful accounts showing a credit balance of 528. Well, I'll be. But you just know that you just calculated your balance, your new balance should be 2,228. It's the end of the year. It's time for that bad debt expense. What can you write off? Well, you can only write off the difference. This is what you want the balance to be in the allowance account. You can't ignore the fact that that's already there. So you can only adjust it by the difference. So the bad debt expense will be $1,700. Why? Because that $1,700 adjustment will bring the balance in the account to where you want it. Thus, that is your bad debt that you can claim that year. Again, there's already a balance in there you can't ignore. What you're calculating is what you want to be in there at the end of the period. You write off the balance. Fascinating. All companies need to note what their allowance is and other types of things, what their credit losses are in the notes to financial statements. So you'll read about this in all corporations. Right? They have to note that. They do explain it. So here's the bad debt expense in action for your do it exercise 2. Now it's 2A because there's 2 parts to learning objective 2. So here we have Brulee Company, and isn't there like a cream brulee? It's a great dessert. I haven't had it in a while, but oh my God, I'm mouth watering here. Anyway, don't talk about desserts with the fat guy. Here we go. 5 years later, they've been in business for 5 years rather. They have the following information. Their accounts receivable is $30,000. That's good to know. Their sales revenue is 180. Do we need that? No, we don't really give a rat's, backside about their sales revenue. The allowance for doubtful accounts, look, has a debit balance. Uh-oh. That means if you looked in the allowance account, the allowance for doubtful accounts, ADA there, their $2,000 balance is here on the debit side. We need to have it on the credit side. Okay, but Darth Vader would be happy. Go to the debit side. Okay. So what we have here is we're going to estimate 10%, it's a simple 10% of receivables, 10% of the receivables, 30,000. So 10% of that is 3,000. So in other words, we want the balance in the allowance for doubtful accounts to be a $3,000 credit balance. The allowance is a contra asset. Balances are on the credit side. So how do you get from a $2,000 debit to a $3,000 credit? Well, it's a big number, 5,000. A $5,000 adjustment is going to get you there. So your bad debt expense for that year will be $5,000. Your allowance for doubtful accounts will need a credit for $5,000 to move you to your preferred $3,000 balance that you wanted. Again, there's already a balance in there that you have to take into account. Hallelujah. A couple of quick notes. First, you can actually sell your receivables if you need cash. It's an asset. It has a value. Companies that buy receivables are called a factor. Okay, so you need to factor that into your thinking here. Factors can be either finance companies that specialize in this. Some banks have operations that specialize in the collection of accounts receivable as well. When a business sells its receivables, they are not going to collect the full value of the receivables because the factor, the company that's buying these receivables, charges a commission. Okay, which means that the business selling them is not going to get full value. So let's see how that works. And again, they do this when they need cash. Why would you sell the receivable? Because you need cash. You don't have enough. What about a line of credit? You may not have enough in your line of credit. You might have already be tapped out in your line of credit. And you need to sell this. Okay. It does happen. Very, very realistic thing. Here we have another furniture company. I feel like going to Raymore and Flanagan, all this furniture, I'm not sure, They have $600,000 of receivables that they sell to federal factors. Federal factors has a 2% service charge. Isn't that nice? So that means that they're going to have to pay $12,000 to federal factors to sell them the $600,000 of receivables. So how does it work? Well, for the furniture company, they're only going to be collecting $588,000 cash because they have to pay the $12,000. Okay, so that $12,000 becomes an expense. And as you see, they sold off their accounts receivable, so they credit accounts receivable to show that that is no longer theirs, but they have the cash. Another thing that you need to know about and understand is a credit card sale. When a merchant, like a retailer, accepts credit cards, that's not a receivable to them. The credit card company has promised them they're going to forward them the cash. Okay. You get the bill. The merchant doesn't get the bill. The merchant gets the cash. But the merchant, in order to get that, has to pay a fee to be part of the network. So in order to be part of Visa or MasterCard or Discover or American Express or any of the other ones that are out there, the merchant has agreed to give up a certain amount of every sale in the form of a fee. However, they will get the cash forwarded to them by the network, Visa, MasterCard network, usually within 1 to 3 days. So it's a cash sale for them. Big advantages as to why retailers accept credit cards in the first place. First of all, they don't have to do a credit investigation on every single customer that wants to buy something from them. The bank takes care of that. The bank who issues the credit card takes care of that. The bank also maintains the customer accounts. The business itself doesn't have to do that. It's less expense. The bank deals with any collection issues, not the merchant. The merchant gets the cash. All they agreed to is pay the fee. That's it. Right? And of course, again, they do get the cash very quickly. And that's important to merchants. Okay. So here's an illustration of that in brief. Marie Morgan buys a lot of music, $1,000 worth of music for her restaurant from Songeroth Music Company. She puts it on she uses her Visa card to buy it. Visa charges 3%. Okay, so what is the music company going to look at? They sold $1,000 worth of music, but they took the Visa card. So they're going to record cash debit of $970 because 3% of 1,000 is that $30. That's going to be an expense, but they are going to record the full $1,000 as sales revenue. Okay. So the do it exercise 2 is on factoring. Here we have a wholesale company. They need $120,000 for payroll. That's a damn good reason they need cash. They've reached its debt ceiling already, so they can't borrow it from a bank. They've already reached the debt ceiling there. So they decide, look, we have $750,000 of receivables. Let's sell off $125,000 of it. That should give us enough cash to cover payroll, and we're all set. There's a 1% service charge on the sale to the factor. So what is this wholesaler going to be doing? They're going to be collecting $123,750 of cash. So they debit cash for that amount. 1% is going to be an expense of $1,250. And they're going to sell off their $125,000 of receivables. So there you go. In a nutshell. How'd you do?